I wonder if you could give us a little bit of your philosophy for early assets. And I think you have a law of 30. What kind of assets are you looking for in terms of companies? What kind of numbers are you looking for those companies?
Yeah, generally speaking, we stay away from binary outcomes. So we do not do biotech. We don't do pre-revenue stuff. Crypto, we're just not smart enough to do that, so we stay away from that.
Sounds pretty smart to
Not
So
me.
smart enough or not crazy enough, you know?
I'll let you be the judge of that.
Right.
So generally, what we're looking for is real revenue. We're looking for companies that have product market fit that are going to withstand the test of time. We're not looking for cyclical companies that are good trades but maybe not great investments. So generally speaking, what we tell people is companies have to be doing at least 30 million in revenue as a baseline with 30% year-over-year growth, 30% margins. That's usually Series B plus. The nomenclature has
Right.
changed quite a bit.
Do you feel like that's enough? I mean, I think we probably started out with similar targets when we were jumping into the market 5, 6 years ago. I think we've had to up those targets a little bit, either on the revenue or the growth, to really get comfortable that these companies will get public within 5 years or get to some kind of exit.
Yeah, that's a great point. Generally, right now, the dynamic is that the demand for liquidity is significantly more than the supply of capital to satisfy it. And
Yeah.
so that allows us to go upstream a little bit. We call it our law of 30, but it's really a law of 50. The reason we go to 30, and I'll tell you
Yeah.
why. So most of the companies we're investing in are approaching 100 million in revenue. The reason we have done, we've expanded it a little bit, our aperture, is because there was, back in our bull VC days, there was a company growing 300% year over year with 38 million in revenue. And we passed on it. Now,
Wow.
in hindsight, we should have done that deal, but we were trying to be we were trying to be disciplined, and we said,
Right.
nope, we got to be at 50, right? Now, on the flip side of that, we're looking at companies doing 4 or 500 million in revenue, and there's a law of large numbers, and so those companies were growing at, call it 40% year over year, and we passed on those. Those are also great companies that we should be investing in. So the law of
Yeah.
30 is kind of our baseline and what we tell people just to give us a little bit more flexibility. But right now, because of the market dynamics and the supply of sellers that are out there right now, we have gone upstream.
Right. So maybe if you could give us an example of a transaction you've done recently, where does that fall in terms of, top 50, top 100 companies, amount of revenue, amount of growth, whether they're profitable? What's kind of a down the middle deal for you guys?
Down the fairway is kind of, are you familiar with a company called DailyPay?
Little bit,
A
but
little bit, yes.
Yeah, so they do earned wage access. The whole idea being the fact that you get paid every 2 weeks is just arbitrary.
yeah.
And there's a
Right.
lot of people who live paycheck to paycheck who need their money sooner than that, or need to pay a bill or what have you. And a lot of this has been proven that those employees are happier and they show up to work more often because they're not missing work because they got a flat tire. They're able to pay for
Right.
different things.
Yeah.
And so this company we looked at was growing a tremendous amount. We believe that they're pre-IPO. They're well over 100 million in revenue. Depending on what how the market acts and if that window opens more than it is, right now, we'll see what happens after SpaceX and Anthropic and OpenAI, and if they suck all the oxygen out, or if they open up the market.
Right.
But this is
They have been sucking all the oxygen out. I guess the question is, will
Yeah.
others take their place, or are they not big enough yet? Because I think once you get those three companies out of the mix, you've got 3, 4, maybe even $5 trillion worth of market value. The rest of the secondary market is a lot smaller. I mean, maybe ByteDance is the one company that's like halfway to $1 trillion, but I think the rest of the market is below 200 billion in value.
Yeah, but you add those up, like there's Stripe, that's probably up there. There's Databricks, there's still some
Right.
really good Revolut.
It seems like the market has become more of a stock picking market than a fund investor market. Is that your opinion? I feel like we're in the fund business, but a lot of
Yeah.
our clients and customers, they like picking individual stocks and companies.
Yeah, I think that's absolutely true today, but I think we're going to see an evolution here. I think there will still, like, there's two strategies, right? There are people who are really good at picking stocks, and some of these are clear winners, and you're going to want exposure to those. But really, it's becoming an asset class. And so, what are you going to do? in public markets, are you just picking 4 or 5 stocks and that's your entire portfolio? Or are you picking those couple stocks, but you're also investing in an index and getting a diversified pool of assets? I think they're complementary and adjacent. I don't think it's binary. I don't think it's one or the other.
What's your perspective on the whole SPV market? I guess, it seems like there's been a lot of growth in that market, and then all of a sudden a lot of controversy. I think specifically from Anthropic saying,
Yeah.
ixnay on the SPVs. Do you feel like SPVs are here to stay and growing, or they're going to be more scrutiny and oversight?
I think there will be some more scrutiny and oversight, and I think it'll be here to stay. First, let's talk about why they're happening, right? And what happened with Anthropic and SpaceX. These companies are raising more money than we've ever seen before, and not by like a
Huge
little bit,
amounts of
by
money. Yeah.
by multiples of what we've ever seen before.
I think it's only recently that we've seen venture capital funds that are more than $1 billion. That's a relatively last 5 to 10 year phenomenon. Now we have, maybe 10 or 20 VCs that are managing more than 10, 20 billion in assets, but it's not like there's hundreds of VC funds out there writing $1 billion checks. That's just, even today, that's still a bit unusual.
Yeah, so imagine being in this fund early and having a significant portion. And so when it comes time to pro rata,
Yeah.
that pro rata is larger than your entire fund or your entire AUM,
I
right?
think Benchmark just raised a new continuation fund for a single company that was $400-500 million.
Yeah. So what do, right? So you end up taking your pro rata because why wouldn't you? It's a great company. Everybody wants access. Yeah. And look, SPVs are great because it helps satisfy what the company wants, which is they want a single line item on their cap table. They don't want to have to deal with all these people. So it's like angel syndicates on steroids, right?
I think this is the concern, is that, do the people who are selling you these deals actually have access, to the companies? Are they going to go find access with your money? Or are they going to take your money and go to Rio?
Right. Well, and believe it or not, this was happening in 2010 when Facebook was still private, and there
Yes.
was fraud.
How do you guys underwrite the investments that you look at? Do you get access to financials, or are you comfortable operating without, perfect information when you're making investments?
We approach it the same way any other VC firm with a fiduciary responsibility to their investors does, and we do need to underwrite it in the most appropriate way that we can. If we are unable to get the information that we need to make an informed decision, we'll pass until we
Yeah.
can't. And we'll just go to the next one because there are plenty of investment opportunities out there. And the way that we view this is we have a fiduciary to do our homework. That's why people pay us.
There's no map. It's just green.
No, there's a map there. Look at the monitor.
Right? Oh, God. Ron, where's my leg?
How many companies are you guys diversifying across in your funds? What's your portfolio construction look like?
Generally speaking, we put it into 3 buckets. So we write smaller checks for scout companies, and these are companies that we are starting to establish a position in, where and they're a little bit lower or earlier stage. So this is the Series B plus, somewhere between 50 and 100 million. Then we have core positions. Usually our core positions graduate from our scout positions. And then ultimately we have upsize positions, companies that we have a tremendous amount of conviction in that we're willing to go up and write bigger dollars or bigger checks for. And there's obviously a lot more volume in the scout positions, a little bit more concentrated in the core, and then obviously 1 or 2 upsize. I mentioned it before. So we have the thing called earlyasset.com for, I don't like this comparison, but Carvana for private assets. So what we see
You
is
have companies sitting in a big escalator that's sort of
on the
like
side of the
rolling
highway.
down.
Exactly.
Right.
So the idea here is there's just a tremendous amount of friction that we talked about in the secondary market between buyer and seller around price. What is my stock worth? And in the private markets, it's a little bit more complicated than just what was the last round price, because there's many different classes of stock. And so we do a waterfall analysis. We value every single class of stock based on the liquidation preferences and the participation rights on the capital structure. You've got it up on screen, secondary OS. Secondary OS is the company side of things. So what we were noticing is that there's a lot of companies that have become allergic to secondaries just because of the volume. And it costs a lot of time, money, and effort to facilitate these secondary transactions. So what we wanted to do is we wanted to address that too, again, to remove the friction, to partner with companies to help them provide liquidity for their shareholders that need it without it being a heavy lift in terms of time, money, or effort. A company could come in, they can approve a transaction, and it goes, and we automate the ROFR process, we automate the closing process for them. And so again, there's just a lot less back and forth. We also provide the legal documentation if they need it. They can use their own or they can use ours. So we put it into 4 buckets to come up with a company valuation before we do the waterfall analysis and understand what every class of stock is worth. And it's basically 4 big buckets. The first bucket is, what are the macroeconomic conditions right now? So for example, if PPI runs hot, that means inflation's hot. If inflation's hot, interest rates are likely to go up. And if interest rates are likely to go up, private market valuations tend to come down. And so we're looking at global macro stuff. Then we basically classify every single company in both public and private. And then we look at similar companies in both the public and private markets. And we effectively put a private company into a public index or multiple indexes or ETFs. So we get a sense for its comparables, what revenue multiple should it be trading at, and what is the exit value. So if this company were to have an exit today, where would it be trading? And then we look at the performance of the company. The big things are revenue, growth, and margins. And how is this company performing relative to its peers? And then they get a premium or discount based on that. And then the last thing is the seller dynamics. So how much are you selling? What class of stock do you have? And what is your urgency? How quickly do you have to move? And so that's how we come up with the valuations of the companies, and then value every class of stock. And then so we basically have 3 different prices that we give you, or that we're looking at. The first is, what was the last round price? It's just something that people like to look at and, say what the discount is based off of that, even though we're looking at apples and oranges many times because they're different classes of stock. Then we say, what is the exit value? If this company were to have an exit today, what would it be worth? And then what is the liquid value? How far are we away from an exit? And are we going to be holding this? And there's time value of money. And so then we do give a discount based on those factors.